Hi folks, well here we are on a very, very wet, soggy Tuesday evening in Wollongong. It's so wet. I persuaded the dogs to go out a little earlier and they looked at me and said, "You've got to be mad, it's raining too hard." So anyway, we got them round and back, but oh dear, it is wet. Anyway, I'll put the pre-show on for a second as two. Nice to see everybody on, some familiar faces and a couple of new ones. Great to see you all there, and welcome to the show. We're waffling on for a moment or two just to let people catch up, but I will just switch to doggy cam. Now that's Luna. I'm not sure where Meteor's gone. She was there a second ago, but she's shot off somewhere at the moment. But Luna is now just saying, well, I'm just going to go to sleep. If there's nothing else to do, then that's what I'm going to do. So Meteor, where are you? Hey? No, don't know. Oh well, there you go. There you got one doggy cam, at least not better than nothing. And good to see a few more people coming on. Very important conversation tonight. I've got Damien teed up ready to come in, and we're going to talk a little bit about the question of policy missteps and how all the events in Europe and elsewhere are playing into what's going on, and how we should be thinking about the markets, and whether investing is good or not, or whether all those good questions. So I think it'll be a really interesting discussion tonight, and as normal, so many things to talk about, so should be good. Okay, so and just to before we start, formally just say, if you want to ask a question, feel free to ask a question. There'll be plenty of time for that as well. Anyway, let me take the pre-show off, and I'll run the intro, and I'll be back in just a second. Well, good evening and welcome to this live stream event on the first day of March 2022. Martin North from Digital Finance Analytics here. Great to have you on the show. And thanks for spending some of your rather soggy Tuesday evening with us. It's a very important conversation tonight. And I've got Damien teed up ready to come in. But just before I bring him in, let me just remind you, as normal, we don't provide specific financial or indeed legal advice on this channel. Please do play nice in the chat room. It is moderated. This is as at the 1st of March 2022. If you'd like to ask a question, and I do encourage you to pose questions to Damien, use that Walk the World to make sure that we see the question. And also, I've enabled Super Chat, so if you want to get your question top of the list, you can, or indeed make a contribution to running the costs of the channel. That was always greatly appreciated. And I guess just to say that the chat is there to be used. Feel free to use it and have debates with each other. But if you want to get your question thrown to me, use that Walk the World so I can see it. Right. With that done, let me push this button and bring Damien in. Hello.
Martin, how are you going?
I'm very good. How are you going?
Very well, very well. One of the few times we can say it's drier in Melbourne than the rest of the country.
I know you've had a good summer, actually, from what people were telling me.
Yeah, has been nice, but So don't want to put it. I guess we should throw out the sympathies for anyone in sort of northern New South Wales and southern southeast Queensland.
Yeah, absolutely. Doing it. No, it is very tough, and unfortunately, I've spoken to a few people today who've are out of their places at the moment and under significant amounts of water. Now, you might just want to shuffle slightly. You sort of shuffled slightly.
Yes, I've shifted the wrong way.
Yeah, exactly. That's better. Yeah. That looks as though we actually mean it now.
Well, that's it. That's right.
Anyway, look, there's a lot we can talk about tonight. I guess what I'm really interested in, and we've discussed it a few times on the show, is central bank policy missteps. In other words, given everything that's going on, given the complexity with inflation on one side, the Russian situation, and the IPCC report today as well, there's a layer on layer on layer of things going on. And central banks are worried about inflation on one side, but they're also thinking, well, if I raise interest rates, am I going to actually reduce momentum? What does that do to markets? I mean, there are so many moving parts. My theory is we are set for policy missteps. There's no way that they can keep all of these things in the air and actually make all the right decisions. But I don't know. Am I over pessimistic, or do you think I'm on the money?
I think I probably wouldn't characterise it as being no way. But I think the odds are odds are on for a policy mistake, and that's the way we've sort of positioned our portfolio for the last few months. And throwing Russia into it just gives us another 6 different layers to it. And then there's this I've spoken about this. Well, actually, sorry, I should start. There's a concept of reflexivity that's which is that the actions of markets then actually affect policy and they can affect other things. And so
there's a feedback loop, really.
Yeah, you get this feedback loop.
Yeah.
And in terms of the stock markets at the moment, I sort of feel there's a feedback loop in that if say we got some quick resolution to the Ukraine and stock markets boomed, then that would sort of give the Fed then, I guess, the license to then jump on it a bit quicker, or even if there's not a quick resolution and stock markets start going up, I think then you get this part where the Fed can then start raising rates. They'll look at it and start raising rates faster, which is then probably going to bring the stock market back down again. We've seen that's what's caused the problems at the start of this year. Is as we see rates start to the odds of rates going up, that's what the stock market sort of really suffers from. And the flip side is if we do get a big fall in stock markets, there's a reasonable chance that the Fed would actually delay what they're doing in order to try and they say they're not there for the financial markets, but the reality is they are. They've blown this big bubble. They've pushed up valuations. So the whole idea that if you can keep people feeling wealthy, they'll get out and spend money. And so, I guess we're central banks are all in on this asset bubble, and so they they do have a responsibility to keep it going if they don't want that demand to fall away. And I think that if we did see reasonable falls in the market, then that's a buying opportunity to we've already seen some, but I still think there's a bit more we could see, and we'd certainly be looking upon in our fund as that as a buying opportunity to take advantage of.
Yeah, and it's interesting. I did a post earlier on today when I said that I suspect that the Fed will be happy to live with higher inflation because the alternative is for the recessionary forces to really start pulling the markets down, and the momentum in the economy in the US is really not that strong. And there's another factor which I think is worth thinking about, is that higher inflation reduces the true value of the debt that already exists. So in a way, you could argue that actually higher inflation is good for the outstanding debt that is there.
Well, I mean, in the end, that's the most likely way we'll get out of the debt we're in, because in the end you either have to grow your way out of it, and in terms of your economic growth, and I think we've sort of reaching some limits there in terms of what we can do. You've got to write it down in some fashion, whether it's debt jubilees or the people who've made the loans, need to take losses on it. And the financial crisis showed that central banks aren't really popular, aren't in favour of letting investors take the pain. They say they want to jump in and bail them out at any opportunity. So the only thing left is some inflation. But and the other thing to add to that is this idea of commodity inflation. Traditionally, central banks ignore the commodity inflation because that's the part, and you often see that it'll be X food and X energy is two of the main things you see. And the reason why is because they act as an extra tax on people, and there's nothing that raising, or there's very little that raising or lowering interest rates can actually do about bringing the oil price down. They need to that needs to. It's usually about bringing on more supply or other factors that causing a recession while you wait for more oil wells to be built. Isn't sort of a popular way to manage an economy, and so that's why they'll sort of they don't do that. But we've got this big inflation boom on at the moment, and then we've got problems in Russia and the Ukraine, which are pushing up both food prices. The Ukraine and Russia are both big exporters of wheat and some other food commodities. Plus, Russia is one of the world's biggest suppliers of energy, and so you're looking at extra inflation from them. And so, I'm not quite sure how the Fed's going to be looking at it. There's certainly some people in the Fed who'll be looking at that saying, well, that's just going to keep inflation higher for longer, which is going to then embed expectations of high inflation, and so therefore people are going to ask for wages, and so we need to jump on top of that. and there'll be other people at the Fed arguing, no, this is an extra tax. This is going to bring, this is going to send the economy into recession. We need to loosen up on the reins. And so, we're yet to really hear that debate happen within the Fed. It's sort of, we've had a little bit of that debate because a lot of the rises have been in commodities or within some sort of temporary items, things like used cars and things where we've got shortages that are sort of very similar to that commodity side. But it's going to be, as you spoke about, there's plenty of opportunity for the Fed to make mistakes in either direction.
And not just the Fed, I'd say. I would suggest that all central banks, the RBA came out with its results of its meeting today, and I might just put up just a quick summary of a couple of the points because it's quite interesting. But what they didn't say, right? So they've now shifted the conversation from the wages more broadly to something called labour costs. Right, which is sort of making it broader, right? More wriggle room there. And they're saying that inflation has picked up more quickly and, it's going to probably be an issue. Financial conditions are very accommodative. They're going to be patient. And there was no mention of any movement on the rates this year or next year. So you can basically say they're doing a holding pattern there. Nothing in that thing today gave any indication that they are actually thinking of shifting rates higher anytime soon, despite the fact that some of the markets, of course, are actually pricing in a rate rise this year, maybe August for Westpac, right?
Yeah, and if you look at longer-term rates, the Australian long-term rates are higher than the US long-term rates. So we've got inflation in the 2s. They've got inflation in the close to 7. They've got some reasonable wage growth coming through. We're looking at the wages saying it's still pretty anemic. And meanwhile, in the longer term rates, rates are still higher in Australia than what you're seeing overseas. So, I think the Fed, and the other thing to keep in mind as well is the Fed has a review coming up of their, of what they've been doing. So we haven't had a review of the RBA for a while. Sorry, I think I said Fed there. the RBA is having a review, and they've failed on the downside with inflation for most of the last. I've lost track of how many years it is. It's like 5, I think, isn't it? Basically, since the governor was appointed, they've been missing their targets, and so you would think that their emphasis now is to miss the target on their upside. At least a year or two of that shouldn't break the bank.
Well, averages out, doesn't it? Isn't that what they said? But basically, they changed. Most of the central banks said, well, we won't try and just hit the target. We'll allow it to go up a bit because it averages over time.
But I guess that's the Australian central bank has had that for a while, though.
That's true.
We're going to 2 to 3% on average over time, whereas most of the other sort of have this 2% target. Most other central banks have had this 2% target, which is the ECB seems to be an upper limit. Which is like, will it be below 2%? And the Fed sort of, the US has sort of, been around 2%. Has been its sort of mantra.
Absolutely. And I will just show this. This is actually the 3-year bond for Australia, right? 1.399 at the moment, which is considerably up from where it was a little while ago. I noticed that the 2-year is. It's come back a bit, but it's still quite high relative to where it was previously. And the 10-year has come back a little, but not a lot, right? I mean, it's 2.166, right, which it's still pretty high. And it's interesting, as you say, that if you compare it with, let's say, the US 10-year, right, the US 10-year is 1.834. So in other words, we're actually predicting a higher rate if you look out
over
forward
the next 10 years.
Over the next 10 years than the US, which is interesting.
And given the US is going to take off before we are, so they're lifting earlier. Our average rate over the 10 years is the market is saying our average rate over the 10 years is going to be higher than the US. That means we're going to have to make up a lot more in that sort of middle period. We're going to have to go over and above, and that comes back. A lot of that comes back to now the RBA credibility, because this is the other problem that they've got, because they came out and said, we've got this 3-year rates that they're going to defend, at 10 basis points, and then they didn't. when markets pushed them. So the markets pushed a little bit, and they pushed back, and then the market pushed again, they pushed back, and when markets pushed harder, they basically just went back and went, okay, we told you that we're going to keep it low, but you know what, the markets seemed to want it to go higher, so we'll let it go higher, and they didn't. And so I think from a guidance perspective, I do think the RBA has lost a reasonable amount of credibility, especially in the eyes of international investors. And so, I think it's one thing to say, I think even if they had pushed back and held it back down to their target and then come out and said, you know what, we've decided to let it go and then let it go, then there's some credibility to it. And here's the reasons why, at least they're sort of but it really looked as if the market basically made the RBA do whatever it wanted to. Absolutely. And the RBA sort of pushed back a little bit. And as soon as the market was pushing harder, they just sort of stepped back. And so, I think there's the problem now with Ford. The problem they've got is that it's the boy who cried wolf type thing. We told you, we gave Ford guidance, and then we didn't stick to it. So now, if they want to give Ford guidance, the markets will may not believe what they're saying.
No, and this is interesting because if you go back a few years when the Fed was starting to tighten and effectively unwind some of the stimulus, the markets basically bullied them and they gave up. So yes, you do see the power of the markets. Yeah,
and this was the Jay Powell, comes along and says, that my job isn't to bail out markets. My job's to run inflation and maximize employment. And then when the markets all panicked over Christmas 2018, I feel like maybe 2019, no, 2018, I think Christmas 2018. Then he did. Yeah, he panicked and he was there to bail out markets. So,
and Fraser Saul makes an interesting point, and I think a very valid point. That Australia must have rates above the US, as we're viewed as an old-fashioned commodity-based economy. If we don't keep rates high, then we won't be able to get overseas funds. There is some truth to that, isn't there? But the RBA also will be quite keen to see the exchange rate a bit lower. So there's an interesting contention there too.
And we do, there's a few things. So we also have we've got a higher target. So because our inflation target is between 2% and 3% over the cycle, whereas the US has a 2% target. So, there's a 0.5% there you'd expect to see over the longer term. And then, and that actually probably accounts for a lot of it. But I think our economic assessment of Australia, where Australia sits versus where the US sits, is that it makes a lot more sense for US rates to be higher than Australian rates at this point in the cycle. I think there's, I think especially a lot of the inflation part gets brought back to, there's an inflation problem in Australia, and it's like, well, there isn't yet. Maybe there will be, but right now inflation's just into the bottom of our band. So
And today the trade surplus came out, right, and it was actually pretty strong. Slipped a bit. And once again, it shows that, compared to history, we've done pretty well. And the reason we've done pretty well is the old faithful commodities. Right?
Yeah,
right.
Absolutely.
So we continue to throw the commodities around the place, and of course the fuels, including LNG, with the natural gas crisis, is also supporting things. So our economy is still quite narrowly based, and it's still very much resources based. There isn't a lot else going on really, and
I just want to highlight a few things on this graph as well.
Oh, go on. I'll put it back.
Back up.
Yep. Sure.
So you look at that fuel. You look at the fuels, and particularly the LNG. That's at that huge growth in terms of billions of dollars. Australia doesn't get any of that. We get hardly any of it. Like we don't get tax revenue on it. Like the tax revenues are minuscule. They're still working through all their losses, and most of those are owned by the big overseas companies, which are then taking that money and they spent. The Gorgon was $50 billion. So at the time, it was sort of 5% of Australia's GDP was spent to build this one project, and so they're trying to recoup their money back. So a lot of that money, even though there's sort of a notional amount there, the money goes in to Australia and then goes to Chevron and straight back out again, and so and without paying royalties of any meaningful amount. So that one I have a personal I have some personal problems with how that's all done. But the metal, certainly the metal stuff, is and the coal. The Australian government makes lots and lots of money from royalties on those. So that's a positive for us. And so you spoke about the IPCC report coming out today, and I one of the things I guess I wryly say is that Putin's effectively given us a carbon tax. So for all the damage it's doing, one of the positives over the last year of the Russian is pulling back on the amount of gas they're providing. And I think we ran through the charts in the last few times we hear about. You can sort of see how they were pushing as much gas as they could through pipelines that weren't going through the Ukraine or Poland. That's ended up with these higher energy prices and very high, hugely inflated prices in Europe for gas. That's effectively a carbon tax pushing people back towards renewable energies. And at the prices, if they had to pay for gas at the current prices, for the next 10 years, if people thought that's where gas prices were going to stay, then the whole of the European economy would be going to renewables and maybe a bit of nuclear as well as quickly as they could, because at current prices, it just isn't worth it. And part of the good thing with gas, in a way, from a climate perspective, is not a lot of there's not as much in the actual gas plants. So if you look at how much the gas costs, let's say we're talking about just got to get my figures right, $6 per kilowatt hour. I think I've got that right, or megawatt hour. I'm either out by 1,000 or not. But if you looked at that, about half of it is the cost of the gas. And when you get gas prices, so when gas prices go up like now you're talking about $12 and above. So it really makes a big difference. Whereas nuclear power, for example, it's all in the original build of the nuclear plant and the disposal of it once it's done. And so what you find is that the price of uranium actually hardly has any effect at all on the actual overall price of electricity. And then coal sits somewhere in between, where there's quite a lot of it, but the coal price itself, by doubling, doesn't actually make as much difference to the price. So one of the few good things to come out of it is we are accelerating that economic process, at least, towards renewable energy.
And I might just put up the Brent. This is the latest Brent crude futures, right, which is 101.13.
Cracked 100. It sort of felt like it wanted to get to that triple digits for the last little while. We've sort of been saying that the price had to rally, and it's interesting that some of those days where oil prices rallying, we actually saw oil stocks falling though. So oil stocks have certainly lagged. BP, of course, is having to sell 20% of its profit. That's right. And Shell also got out of their deal with Gazprom as well. But so ex those ones though, there were a couple of days there where we were seeing oil prices taking quite big jumps, but you really weren't seeing the follow through in the oil stocks. And I think that's a reflection that the oil stocks understand that the higher this oil price goes, that also accelerates the transition across. Absolutely. Now it's not quite at the level for where I guess in the way I look at it is we've got this alternative source in solar plus batteries, and that's sort of that comes down every year, and we've had the cost of coal sort of headed up, and that we're pretty close to that switchover point. In Australia, we're pretty much there. In Europe, it's going to take a bit longer, but you get some high energy prices, and it helps to accelerate that switch. In oil, we're not quite there at that same point. So roughly on my figures, if you're driving 60 to 80,000 kilometres a year or more, it's financially better for you to have an electric vehicle. Petrol prices go up. If they double, then that comes down to maybe it hits to sort of 40,000, maybe 30,000, but it's still not at the level that most people would drive. And I think once you hit that sort of $10,000 to $20,000 where it starts to become worth people, that's where I think we'll start getting the real acceleration of EVs in the same way we're seeing solar power, take off in Australia.
And I just put up the WTI, which is at 98, so that's moved up 2.61% in the last session. So you can again see the upward pressure. And I was reading something today, which I think it was on Bloomberg, when they were saying, well, the supply-demand equilibrium point we'll find a level. They will come back, but in the meantime, as you say, this is a huge fillip for the renewable sector, and it's probably leading us down a quite interesting path. Though, of course, there's a timing question here, isn't there? Right? I mean, if Russia turns off the gas tomorrow, right, and what is it, 50 or 60% of German gas comes from Russia? I mean, that's going to hit immediately. You haven't got time to react. So there seems to be a timing question in all this.
Yeah, absolutely. But I think and we'd said it even before he attacked the Ukraine. He's overplayed his hand, though. The fact that he let gas prices get so high in Europe over the last winter basically meant that it brought the issue to every politician's mind. We need to get away from Russian gas. We need to find an alternative and renewable. We know we need to move to renewables at some stage. We may as well start doing more of it now. And whereas I think if he had he could have sent the warning shot across by letting gas prices go a little bit high to remind Europe, but he didn't need to set it to such extraordinary heights as what he did, and then to go and invade the Ukraine as well, then to sort of doubles down on that every politician in Europe is working out, how do I get away from Russian gas? How do I make it that we're no longer dependent upon it?
Absolutely. And here's the natural gas futures, right? Which is sitting at the moment at 251. It was up to 450 here a little while ago, right? But you can see historically it's been knocking around a 50 to 75, and right, it's now way, 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 way higher. So that tells you something quite important, I think.
Yeah, absolutely. And so, and the thing for the Russian gas as well is very cheap to get the Russian gases out because they don't have to liquefy it. Whereas Australia or gas coming from the US has to be liquefied, and then there's that whole cost to freeze it, cost to stick it on a ship, and cost to unfreeze it at the other end. But in terms of where prices are at the moment, it is extraordinarily profitable to do that. Anywhere, whether it's coming from Australia, coming from the US, or whatever, they're more than happy to pump as much as they possibly can, as fast as they possibly can. So, that's which is a problem for Russia as well. Is that, and it's partly how the sanctions were designed, is that they've designed them to try and take away a lot of the issues and a lot of the source of funding, but they still have to. They can still sell their gas into Europe and their oil, and a lot of that is because it would be very hard for them to cut the taps and say, okay, no more gas for Europe, because they're struggling already to find dollars. They have one source to get them, which is through selling their gas and selling their oil. The sort of they're at the point of cutting their nose off to spite their face if Russia decided not to cut the gas supplies to Europe.
And I found out something interesting, which I hadn't realised, that in fact over the last 3 or 4 years, Western Europe have been re-architecting the gas piping to be able to switch it 2 ways rather than 1 way. So they can actually shove it up and down in different areas across Europe, whereas previously they couldn't. So they have tried to build a bit of a resilient strategy, even if it's not particularly well advanced, which I thought was quite interesting. I hadn't realised that. Yeah.
Well, and Russia... so the other thing people ask is, look, can Russia send its gas to China? And so, Russian gas goes to China, where they're happy to buy it still. And, Australian gas, for example, rather than going to China, ends up or Qatari gas, it just goes to Europe instead. And that is possible. The issue is, as we know, Russia's a very, very big place. Most of the gas is sort of in the middle and sort of a little bit more towards Europe. And so they've built some pipelines across towards China. The problem is it's got to come in from the northeast of China. And in the northeast of China, they've got lots of solar resources, they've got lots of wind resources, and they've got truckloads of coal. That's where all the coal sits in China. And so the coal, and they've built a lot of, and the other thing is they've built a lot of power plants there and are actually shipping the electricity back across the country. So they're shipping huge amounts of coal, right across China, and huge amounts of electricity already from that one area. And huge amounts of renewable electricity, and they've even got some hydro up that way as well. Then if you want to bring in gas as well, you've got to build basic gas lines. You don't just have to sort of get over the border to China. You've got to get over the border to China and then all the way back into back over to the east. And so that's a long way away from being a viable. That's not like they can just say, yes, we'll switch the tap off to Europe and we'll just send it all into China instead. It's that's a probably a decade-long project to set that all up. If China wanted to.
Yeah, you're not going to solve that tomorrow afternoon, right? So
that's right.
Yeah. Now, a little while ago, we had an interesting question about resources and what have you, but they also mentioned gold, and I thought I'd just put the gold price up, right? Because it is really quite interesting, right? It's sitting at 1918 right now. I thought gold was meant to be this super duper, flight to quality. When everything goes wrong, that's where you go. But it's not really happened.
No, that's right.
So the question is, what on earth is going on? Has the status of gold fundamentally changed, or is the price manipulated by people on the other side of the trade? Because, of course, we know that the underlying versus all the positions is about 50 to 1. Because it's not, and I was talking to somebody the other day who was celebrating when it had shot up, thinking, whoopee, we're here. And it's not, it's sort of come back. So I find that quite intriguing.
Yeah, well, one of your problems is Russia has a lot of reserves in gold. And their reserves have been, the central bank there has a lot of reserves in gold, and all their cash reserves have been seized. And so the question is, will the Russian central bank turn into a seller? And because if they do, that's a huge weight on terms of the market. So you spoke about the 50 to 1 issues. One of the thing to remember with gold as well is that investors and central banks is basically where all the action is. Like the actual industrial uses is nothing. So it's always a bet on what other people are going to do. When you see the US dollar rising, as we're seeing, and the flight to the US dollar, then you've got one issue is will China decide? Sorry, not China. Will Russia need to sell its gold reserves, and so that's going to hold you back a bit. And then the other one is, are there other emerging markets out there which are in the same bit? A lot of emerging markets have got a reasonable gold holdings. When the US dollar rises, they start to run into those similar types of problems, and maybe they need to start. They'll need to start selling their gold as well. And so, I think I do want to highlight as well. So I spoke about it so much for being investors in central banks. You're really trying to make a bet on getting in front of other investors. You're not making a fundamental bet. It's about saying, you're not fundamentally saying, yes, there's a demand for gold, for whatever, for electrical wiring and spaceships and all these different types of things and computers. You're saying, no, that demand's nothing. It's the demand for other investors wanting to buy it. And so there is a reasonable argument that maybe Bitcoin's taken away some of your main customers. Yes, and some of the people who are most scared of financial systems melting down, and financial systems and your traditional holders, or I guess longer term holders of gold, have probably at least diversified into maybe some cryptocurrencies, or if not, some of your up and coming younger ones have probably never bought gold and might have similar views, but they're buying cryptocurrencies instead.
Well, it's interesting. Here's the crypto. This is Bitcoin, right? Which is sitting at 43,301, and it's been down to 36, and it's been up to 64, backwards and forwards. And it's interesting. I was listening to somebody a little while ago suggesting that maybe Russians will be buying Bitcoin because that's the only option they've got. Right? So I
think they would certainly be trying. Yeah. I mean, they're out buying. The other thing is they're out buying handbags and luxury goods, trying to get you basically want to get your rubles into something solid. And so the idea is, well, if I can buy a luxury good, then that's something I can then sell, and get US dollars for it. So so they'll certainly try that. But Russia's a big economy. It's 11th largest in the world. It would be very difficult to try and transfer so much wealth through a something like a Bitcoin. So I guess I don't have I'm certainly not. I'm not a diehard believer in it, and I do think that this whole idea of it's freedom and it's haven't got central banks overlooking you, and you haven't got oversight from governments and all that type of stuff. Do you think the Russian government wants that? Do you think the Chinese government wants that? They want the opposite. Well, they want to control everything about it.
Central bank digital currencies. Right?
That's right.
But there's an interesting point, right? Because I think there are some interesting parallels between the Bitcoin world and the gold world, because what we've got now is a whole bunch of derivatives and things built around the central element, right? And it's a one-to-many relationship. So in a way, you are... your point earlier on was dead right. What you're doing is you're actually trading to try and actually out-trade other people, right? But that's what you're doing. And it's actually... so, in fact, Bitcoin and gold are actually much more similar than many people think. Not because gold isn't necessarily the cornerstone and it's always going to be stable and you can, flight to quality. They're both fundamentally influenced by those trading instincts and those moves and all those different things. And the relationship between the one to the many is so strong. Look at all the ETFs now that are, sort of building around Bitcoin, that really you are in understanding that these are actually just completely tradable. And that's how I think about it.
You in both they're both great or fall investments in terms of I'm going to buy this because I'm going to find somebody who will buy it off me at a higher price, and not because I fundamentally think there's value in it's going to generate a return for me, and it's literally just I will get in and I will sell it to somebody else. And so whereas most other assets you're buying because you think it will generate a cash flow stream that will make it worthwhile too. And so
absolutely.
One other thing, the other thing with Bitcoin as well and Russia is I can't remember the exact stat, but I think of all the hacking that goes on, there's an incredible amount already that's they think is emanates from Russia, where the money ends up in Russia. So a lot of the ransomware and all that type of stuff, they suspect at least 2/3 of that the ransom paid ends up in Russia, and so it's quite possible that Russia already holds a fair bit of Bitcoin. And so, there's an idea that, okay, there's going to be this huge rush as everyone in Russia wants to convert their rubles into Bitcoin. That may be true, but it may also be true that there's a bunch of people in Russia who are worried, particularly about Vladimir cracking down on Bitcoin, who are trying to turn their Bitcoin into US dollars because the Bitcoin they've been building up from running ransomware. So, there's that point as well, is that, and even actually the thing about Russians buying Bitcoin, I guess, taking that one step further, is if they're out there turning their rubles into Bitcoin, it's not because they're long-term investors. It's because they're like, okay, I'm trying to turn my rubles into Bitcoin so that I can turn my Bitcoin into a hard currency and get my money out of Russia to something that's going to be a bit more stable.
Absolutely. Now, I wanted to shift the conversation on, because the other thing that's happened since the start of the year is the fall in the Nasdaq, right? And the Nasdaq's quite interesting because, in fact, not all stocks have been behaving the same way, right? So if you take Alphabet, for example, and we'll put that one up there, right? So you can see it's come off, a reasonable amount, but it's, it's still quite accelerated. And the other biggies, like Amazon, are pretty much following the same sort of trajectory. In other words, they've come back a bit, but not dramatically so. But we also know that there are some others that really have dropped dramatically, particularly some of those perhaps that were seen maybe as more speculative, further out before they were going to generate revenue, those sorts of things. So what's your observation in terms of the tech stocks, and particularly in the US, because and the different types of tech stocks and how they're behaving at the moment?
Yeah, sure. So unprofitable tech stocks have have fallen a lot further than profitable tech stocks. And so it's worth thinking as well just about the differences we're talking about in some of these, in that Apple gets put in there as a tech stock, or Google gets put in there as a tech stock. But the reality is these are pretty entrenched companies now. It's not talking about the future, and these guys aren't making much money now, but just imagine the future when they'll be making so much more. They're making good profits right now, and they're growing those profits. And so in my mind, Google and Facebook are effectively the same as a newspaper was, or a TV station was 20 years ago. They're media companies. They're selling advertising. They're going to be subject to the cycles, the same cycles you would have seen on Facebook today. And they do have a sort of this benefit as well of they're still old traditional media keeps flipping over and coming onto their platforms. So within what we've been doing with our portfolio, we've been a little bit underweight tech, but we've had almost none of the high risk or the unprofitable tech sitting within our portfolio. And I think that's often called the anti-ARC trade. So ARC was a fund that Cathie Wood ran that sort of picked up heaps of hype for anyone that missed it. And there's now even like ETFs and things out there that trade basically on the opposite of what ARC is, with the view that, that things got so heated and so bubbly that if you just did the opposite to whatever they were doing, that you'd make money. And actually some of those funds have done really well. The ARC, the whole idea of you buy a good story and don't worry about the price you're paying for it, is no longer there.
So that's the ARC Innovation ETF, right? Which was up at 160. It's now down at 70. So that sort of gives you a bit of a flavour of how things have moved.
And so I mean, it's interesting because we went through I go through stocks. We have sort of stock selections where we go through and we bundle up just interesting stocks and sit around and analyze them from three or four different angles. And we actually went through a lot of the ARC portfolio trying to find, is there anything good left over there? That's I couldn't find anything I really want to buy in there. There's a couple at the right price I'll pick up, but there's a lot as well that were still pretty heavy on the whole story, but missing the earnings. Right,
and of course with those tech stocks that are yet to really start creating revenue, right? With rates going up, the discount of those future earnings, naturally reduces the value of the stock.
Yeah, that's right. So it's the idea that if I've got a dollar today and interest rates are 10%, then I can say, oh well, actually, if I just leave the money in the bank, then in 10 years' time, I'll have all this interest, and that'll be great. So if I'm thinking about do I buy a tech stock or just stick the money in the bank, it's like, well, 10% is a decent return. I can take that. Whereas when we're sitting at 0% interest rates, all of a sudden it's like, well, I'm not earning anything on it. That stock over there that looks like it's going to grow at 10%, that all of a sudden looks a lot more attractive. And so that's sort of, that's the basically the switch between it. And so where were we going with that question? Have I gone down a path?
No. We were just explaining why it was that with rates rising, of course, the expectation of higher rates, the Fed was predicted to do 6 or 7. Some people saying 50 basis points in March and what have you, although they might shade it back now because of what's happening in Europe. But those forward expectations of rates was sufficient to discount the price. Right?
Yes, back in further.
Yeah.
So the question is, is always what is the right price to pay for these stocks, and will you go through another cycle at some stage? And the answer is absolutely. At some stage, people will be prepared to pay way too much for stocks with a good story again, and they'll again boom and go rocketing up. So it doesn't typically happen within a year of the last one falling over though. So I think I don't want to say never, but I do think we're a while away from that. Possibly if we get to the stage where, I think if markets had a bit of a tumble, we're thinking another at least another 7 to 10%, then you might see a more accommodative Fed, and we'd be certainly starting to pick up some of the profitable ones and maybe some of the higher risk ones. But maybe if the Fed went really dovish, something else happened, and maybe we get a financial. I can go through a few things that could go wrong, but maybe there's some sort of financial crisis comes up, and the Fed flips around and goes back to no, we're not raising rates, and actually, we're going to pump more money in to solve whatever problem from the Russian central bank or hedge funds blowing up or whatever it is. Then maybe these things will go rocketing again. They're probably that'll be the first place where traders will jump in. Anyone who's sort of looking at this as a short term, how can I make money? If the Fed flips, we'll be looking at can we put money into Tesla? Can we put money into some of the ARK stocks that are losing money?
Right, and as I put up just now, Fraser made the point that much of the media is focused on share price, but actually the conversation should be about earnings, because in many cases earnings are actually under threat, particularly in a higher inflation environment, particularly with some of that global uncertainty that we've been touching on, and especially as any consumer stocks that are reliant on consumers using those government stimulus handouts that were there but are now disappearing. Consumer activity might be less than many people think. So there are a number of reasons to think that maybe earnings will be somewhat under pressure.
Yeah, so all the signs at the moment are that earnings growth is stalling. One of the real drivers of the markets over the last 2 years was that what was happening was every time you got to a reporting season, companies were expected to grow by 10%, and then they'd come out in their report and they were growing by 15% or 20%. And so, and then the next quarter, the same thing happened again, and the same thing happened. And if you've got that continual upgrade of expectations, when you upgrade earnings by 5%, the market can go 5% higher and be no more expensive than what it was. And that was what really drove it up. That has topped out now. So we're not seeing the upgrades. The last 2 reporting seasons, we really haven't seen the upgrades come through. There's still already growth sort of factored in. So we're getting reasonable growth in terms of the sort of 10% levels are sort of still in analyst forecasts. But if that starts to fall away, then that's when you can quite quickly see the market take some points off. And just to give you an idea of some of the maths behind that, again, so I've bought a stock for, let's say a stock's earning $1, and I've bought it for $20. So on a price to earnings ratio of 20 times. Now that stock grows its earnings by 10%, and then the price doesn't move. Well, now it's on an 18 times price to earnings. So if the earnings grows by 10%, then the price can grow by 10%, and we haven't got any more expensive. The problem is though, when we're paying 25 times, and all of a sudden the dollar goes from or 30 times, and you go from making $1 to making 90 cents, well, you got a lot more leverage on the downside. So if you're paying 10 times for a stock and the earnings fell by 10%, then you're only taking that much off. But if you're paying 30 times already, then the share price has got that much further to fall. And what often happens as well is with those is that people are only paying 25 or 30 or in the case of a lot of the stuff in the ARK fund, 100 times or 200 times the earnings, because they're expecting the growth. And when the growth stops, not only do you see, or even worse, goes backwards, not only do you see fall because of that, but people then go, well, I'm not paying 200 times for a company that's not growing. For a company that's not growing, I'll pay 15 times or 10 times for. And so you get this massive sort of down rating of stocks as well. And which is sort of similar to what we saw to Meta. So Meta, I've got, I'm actually a little bit more positive in terms of the longer term outlook, just because I find it difficult to see how people that want to spend money on the internet, it's actually difficult to find places in volume. It's very difficult to find places other than Facebook, Instagram, Google and TikTok. But Meta very much showed that what happens when user growth tapped out, and people went from saying, okay, we're happy to pay 25 times for future earnings, to suddenly saying, well, future earnings are going to be 10% lower, plus we're no longer prepared to pay 25 times, now we're only prepared to pay 18 times. And so then you get 10% downgrade to the earnings and a 15% downgrade to what you're prepared to pay for it. Gives you 25% plus fall in the share price.
Yeah, and that's quite important because often it's multiple elements coming together, right? As you say, the PE multiple, the forward view of earnings, the discount rate. That's how you start modeling what a stock is actually worth, right?
Yes.
And to me, modeling the individual stocks and trying to understand that is a much more powerful than just looking at the index, because the index is an amalgamation of all these different things, right? With some which will be performing quite well, some less well. And I actually think that all this daily reporting or hourly reporting on, the index is up 5 points or down 20 points, right? Doesn't actually, it may make good news copy because it's current, but it may not be actually that helpful when you actually come to try and figure out what's really going on, because by definition it's a blooming average. If you look at the Nasdaq, the Nasdaq is sitting there, right, it's down a little bit, but as we highlighted, there are some stocks doing very well, there are some stocks doing less well. So does an index really help?
Yeah, well, and keep in mind it's a dollar weighted one as well. So I can't remember the stats on the Nasdaq, but there is an extraordinary proportion of stocks that are down sort of 25 and 30%.
Yep.
Because it's held up by Apple
about 5 or 6.
Much.
Yeah,
that's right. And they're all the really big ones. So they make up your top sort of 5 or 10 stocks makes up similar to it. It's not as bad as Australia, but it's similar. It's sort of 30 to 40% now gets made up by that sort of handful of stocks. And so they hold that average up. And so if you're invested across everything, then that's fine. You can take the average. But if you grabbed a whole bunch of these higher risk names, then you see exactly what ARK saw, that you go from your 160 back to your 70 rather than 160 back to 145.
Absolutely. And just to sort of take that slightly further, I wanted to compare a couple of other stocks. We'll look at a couple of Australian stocks. So I've been quite keen on Macquarie for a long, long time. I had it when it was 10, 12, 14, it's right the way down there, right? And so you sort of say, look, that's pretty good, 183, got up to 200. And part of that is the spread of the likes of CBA, right, which is a much more domestic bank, right? It's a very different profile, right? Now, my interesting question for you is, how would you parse the difference between a CBA and a Macquarie?
Yeah, so look, Macquarie, when I'm looking at it, I just don't even compare it to the Aussie banks, really. It's got part of its business within that. It's really a global investment bank, and so your Goldman Sachs and your Morgan Stanleys and the other stocks to sort of see where it sits. Within Aussie banks themselves, it's the difficulty always with banks and to a certain extent resources as well is, how do I make a proper comparison to what everyone else is doing, because they're not the same type of animal.
No.
They're a lot more leveraged. They don't report the same numbers, so you get there is a net profit that's the same and an earnings per share, but then you start looking at other things throughout the balance sheet and you're not getting that. And so it's one. So there's two parts to it. One is saying, okay, well, I want to look at banks on a relative basis and how am I going to rank them from top to bottom? And so I want to see, where does Macquarie sit, sort of the global peers? Where does CBA sit versus its global peers? And then it's a matter of trying to say, well, where does that whole sort of group of banks that I've got, how does that fit into the rest of the market, and what are sort of the overlays within that? So we've certainly seen over the last night anyway, that a lot of those investment banks got hit relatively hard, certainly more so than other banks, with a lot of this idea that, are there going to be financial plumbing issues going forward from all the different sanctions that have been put on? And that's a very, very real risk within a lot of these, is that we just don't know. Long-term capital management was a hedge fund that sort of blew up in, I want to say the late 90s, and sort of threatened the financial system because Russia defaulted on its bonds, and this was just a hugely leveraged company. It was making the tiniest little fractions on, and actually wasn't actually taking a lot of its positions, ex the Russian ones, weren't actually taking much risk, but they were so big and they'd taken so much debt on that they turned it into risky positions. And so, and that required sort of a Fed bailout. We saw last year, mental blank on the name, there was a hedge fund that blew itself up on Archegos blew itself up.
That's right.
Yeah, and the same thought about, do we need to step in and bail things out? We've obviously had the whole Lehman's and Bear Stearns. Lehman's going under. All of a sudden, everyone froze because nobody knew who owed what to whom. And so, I suspect a banking side is probably going to be all right insofar as there was a lot of regulations. The Russian banks were sort of kicked out of SWIFT, and there's going to be all these problems about counterparties and who owes who what, and I do think though central banks are going to be standing there with the fire hose pretty ready to go. So and I'm guessing even asked the question of some of the Deutsche Banks and people like that before they started by saying, okay, if we do this, what problems does it create for you, to make sure they're not bringing down their own banks. So that's probably all right. Not to say it's not a zero. It's not a zero risk. There's they could definitely get something wrong in that area with all these sanctions. It's probably more likely to be a hedge fund that nobody's possibly heard of, that's just leveraged to the hilt and took the bet, which is often a very sensible bet that geopolitical systems problems will resolve themselves. They usually do. Yeah. And so you go, oh, if I just take this bet every time I see it there. Every time I see a geopolitical problem, I take a bet that it will resolve itself. You might make, you're investing $100, you might make 2% every time. It happens, 4 or 5 times a year, and you're like, yeah, there you go. There's a nice 8-10%, and then all of a sudden, you have one event where you suddenly lost half your money or more. And so there's a reasonable chance there's some hedge funds out there right now who are crossing their fingers and rabbit's foot and under the bed and everything they can to hope that there's some sort of resolution so that they make the money back on whatever they've lost in Russia.
Well, I was talking to somebody earlier on today who actually runs a big pension fund in the UK. And they were quite heavily invested in Russia. They started getting out about 6 weeks ago. And they've basically got about 2% left of their original investment, which was about 5% of their portfolio. So because they had quite good performance over 4 or 5 years, right? And they're sitting with this 2%, knowing now that the chances of getting that out is almost zero because there's nobody on the other side, right? Nobody wants to buy it, right?
And they close the stock market as well. So
exactly right. And everybody else is in the same boat. So they're all sitting on these Russian assets thinking, well, I don't know what they're worth, but they're not worth very much. Now, those sorts of shocks, can really hit you if you've not been paying attention, because the point was they started 6 weeks ago.
Yes, yeah. And then it's the ones where, even that one, you go, okay, well, let's say it's 5%. They've lost 5% of the portfolio. Yes, obviously it's very damaging and terrible, and there's a few managers going to lose their job and everything. But for the investors, it's not the end of the world. And it sounds like it's long only, so they're not going to. It's not going to sort of cause too much problem. It's the ones who have gone out and borrowed, borrowed the money, and stuck the leverage on it, and then they've lost it. Now all of a sudden they've gone from I borrowed $100 and then invested $100 in Russia. Now that $100 is worth $40, $30, whatever, but it's stuck in Russia anyway. There's a bank. I get it into rubles, but I can't get it back across here, and so now I owe $70, and I have no way of paying for it. So, there's and at the time, everyone talks about, oh, we put this hedge on here, and we put that hedge on there, and we've got this, and we've got a swap, and all these different bits and pieces, and then you get things like this where it's like, well, it doesn't matter. The bank you did it with is no longer allowed on the SWIFT system. So, what's your promise worth? And do you think Putin's keen to bail you out? I'm sorry, foreign investor. I'm sorry that the US and all these guys have shut down our banking system. Let me help you. They're like, not a chance. You're the last person they're gonna help. So
well, it's a bit of a mirror image to the Evergrande discussion and about international investors. And will the Chinese government support the international investors? Probably not. No, they're worried about.
And bring that back to a bigger point. Like my contention with government debt as well is you often see government debt funds. foreign government debt funds. I tend to, within our portfolio, we just buy Australian government bonds, because my view is that if you're out buying, say, bonds from France or Germany or wherever it is, you probably don't want the current. None of these, because you're only getting sort of 1% or 2% or whatever. You don't want the currency risk, so you hedge it back into Australian dollars. And when you work out all the forwards and the swaps, you basically end up getting the same rate as what you would as if you bought Australian bonds. So it's basically pretty much the same investment. Maybe you get a little bit more sometimes, maybe a little bit less. But the flip side is, if something goes wrong in that country, they're going to bail out local investors. They don't care about foreign investors. You don't vote in their elections. Whereas in Australia, you're on the right side of that trade. Something goes wrong, and the Australian government owns a printing press. They're going to print money to help bail you out. Whereas that's not going to happen overseas. So yeah, my general take on government bonds is, if you've got a particular view on somewhere where you think you're going to make money with a high risk investment, then sure, go for it. Think of it, but don't put your safe money into a foreign government and think of that's the thing that's going to save me if everything goes pear shaped, because maybe that's the country that gets invaded or does go pear shaped or has a budget blowout or something like that, and they're not going to be paying you.
Diversification probably is quite useful, right? That's one of what you're saying. Now, here's a question from a little while ago, which I thought was actually quite interesting. I might just put it up here. Any global debt denominated in gold? Well, obviously, gold is held by the central banks, and there are also a lot of securities linked to gold. But I'm not sure whether there's any global debt that's directly denominating gold.
I don't know of any.
No.
There probably is, but it'd be a very niche product. Yeah. And I guess there's effectively, if you want to go short, there's ways of going short gold, and so that's effectively a debt. Yep. You can, So
the futures market for gold or options, they are actually ways, and that's my point earlier on, going back to this multi position, to the underlying, right, the 50 times or whatever it is, right? That's a whole sandcastle edifice of futures and options and all sorts of things, right? Of people taking positions and then offsetting alternative positions and taking bets on where the markets are going, right? People need to understand that the gold market is not straightforward, right? Because it is built around all of this sort of edifice. And there are people with multiple positions on both sides of the trades, and they're looking for opportunities to try and actually win and compare to the other side, right? And I always remind everybody, with those sorts of trades, for every winner, there's always a loser.
Yes. Well, and there's usually two winners and one loser. And one of the winners is the broker who's doing the trade. And they're always a winner because they're just making money on the transaction. So absolutely. There's somebody there clipping the ticket. And actually, let me just put that in perspective for people as well. So let's say, Martin, you said to me, let's say you said, okay, you're going to go short 1 ounce of gold, and so 19. So I give you. So just let me get money right. You will get 19. What do we say it was? 1918 or whatever.
Yep.
$1,918 you get, and now you owe me 1 ounce of gold. And so you're effectively, you've got that money, but you have a debt to pay me whatever, to give me that ounce of gold. So you effectively now have a debt denominated in gold. If the gold price halves and goes, or goes down to $1,000, just to make the numbers nice and simple, then you only have to pay me $1,000, or you have to go and buy gold on the market, buy an ounce of gold on the market and give it to me. The flip side is, if the gold price goes up and goes up to $10,000, now you owe me $10,000. So that's effectively you're closest to your easiest way to get a debt in gold if that was what you're trying to do. I don't know. I'm sure that's short. Yeah. That was there.
Yeah, but and of course, if you then think about options, right? If you're on the wrong side of the option, right? Because in one side of the option, you only ever owed that 1 unit of gold, right? So but if you're on the other side of the option, then you can get taken to the cleaners, because basically it's not just limited losses; it's completely unlimited losses if the movement in the market is strong enough.
Yeah, and that's a very important point as well for options markets. Is that options markets, you're buying from what's called a market maker. So they're like a bookie, effectively. And so the thing is with the bookies is they're not taking risks. If you're making a bet on you're going short gold, they're going to go out and find somebody who's taking the other side of that. So they're not taking any risk themselves. They just want to take that margin in between. Every now and again, there'll be some incidental, just in terms of, I've found one leg and I've done that, and I just need to get the time. But generally speaking, they're not trying to take any risks. And so there's some weird stuff that goes on with pricing with that, and how some of the stuff that happened with GameStop, the way effectively what was happening was it was weaponizing these options markets. There was obviously some hedge fund people in there who knew what they were doing, telling the retail people what to do, and they were weaponizing in the way that they were buying at particular times where the market makers would then have to go out and buy extra stock and actually push the price up themselves. And so you get sort of regimes where you go back 4 or 5 years, and what would typically happen would be if a stock price was getting pushed up, the market makers would be selling out and actually helping to sort of dampen the rises and dampen the falls as well on both sides by their activities. The way the structure of the market is at the moment, and it's probably more complicated than we've got time for here, but it's actually generally actually adding to it, because so some of these wild swings in the market, what we're seeing is as the markets are rising, market makers need to get in and actually buy more stock in order to meet their obligations or to avoid the risk. And vice versa, when markets are falling, they've actually got in and got to get out and sell more stocks. So that's actually helping to make the market sort of more volatile at the moment than it might have otherwise been.
Plus all the computer stuff, right?
Yes.
The thing that people quite often don't understand is that there's a lot of computer trading going on, particularly in the volatile market. And a lot of those trades are completely automatic. So if prices move a certain amount, you sell or you buy based on how you've written your computer programs. And I don't know what the ratio of computer trades to non-computer trades is. It's often hard to try and understand it. But my understanding is that the bulk of trades quite often are actually computer generated.
Yeah, and so there's those. So the three big ones, there's all the computer ones, sort of very similar is commodity trading advisors in the US, so CTAs. And a lot of those follow very similar types of trends in terms of all the technical indicators about the your MACDs and your whether it's your 9-month, your 200-day moving averages,
all the chartists, right? They've basically used the charting theory, put it in a computer program, and it just trades automatically when it goes.
Yeah, and the beauty of some of these ones is because so many people are using it, it becomes self-fulfilling. In that everyone says, hey, when the 200-day moving line crosses here and that goes there, then everyone buys, and then when this happens, everyone sells. And so you get these pushes up and down. And now you've got other people out there going, and they're usually bigger funds going, okay, I know that if it gets to this point, that'll trigger a sell for all these people. Yep. And so when they get close, they go, push, let's give this an extra shove, get it over that line. Because if I can get it over that line, trigger all these computer programs to start selling, then that'll actually push it even that little bit further. And then you get the fundamental guys who go, wow, that's really cheap. I'm going to jump in and buy that stock or jump in and buy that market. And so that's where, we've got this extra volatility that you typically see, in market corrections is you get these really big up days and really big down days where computers are getting involved, these commodity traders are getting involved. And then the last ones, and then you've got your, a lot of those also, there's some risk parity type trades, and what they're trying to do is sort of balance out some of the risks by buying different assets. But what tends to happen with those ones is when volatility gets high, like it is at the moment, they actually start pulling back all their leverage. And because they're pulling back their leverage, that sort of helps to push the markets down. And then when volatility gets low, they then go and start taking on more debt and pushing the markets back up again. And so, there's sort of 3 or 4 different players. Often they're very similar to each other in terms of what they're doing at the same time, but for different reasons. But they're all adding to the volatility that we're seeing and tend to be pro-cyclical in terms of when markets are going up, they're going to try and push it up further, and when markets are going down, they're going to try and push it down further.
Absolutely.
And so you're relying on sort of fundamental people to then to step back and go, that's too high, I'm selling, or that's too low, I'm buying.
Yeah, I've got this vision of lemmings, right? They all sort of go over the cliff together, right?
Yeah, absolutely.
And then and then the fundamental value of people saying, "Hang on a moment, no, I wouldn't go that way. I'd go this way." It is a different philosophy.
Yes, and it's about staying in front of the herd. Yeah. So the problem is you can get trampled, but it's there's people who make lots, very good money out of it. It is always the thing with any trading strategy. Actually, I always say to people, especially these quantitative ones, is just make sure why there's a profit in there. If you've got something where you say, okay, I've got, here's my trading strategy. When this happens and this happens and this happens, this is what I do. You're saying you want to know why are you making that money, because there are a number of trading strategies out there which are effectively selling insurance to everyone else. So what you're doing is saying, Martin, you're going to make $1 every day if you do this trading strategy, and once every 5 years you're going to lose $10,000. And for that, while you're making that money, you're like, this is fantastic. Look at this. I made $365 last year. Every single day I made a profit. The next one, every single day I made a profit, and every single day I made a profit. And now I'm up to $1,000 of profit in 3 years, and then all of a sudden, boom, you're down $10,000, and you're like, oh. That didn't feel that good. And effectively, everyone was asking you to buy insurance. It's like if I go out and gave everyone insurance for their house, isn't this great? This guy's giving me $500. This guy's giving me $500. This says, look at all this free money coming in, free money. And then somebody's house burns down. I'm like, oh, just a minute. That's going to cost me $500,000 to replace. So, that it is that, are you selling insurance to other people in the market? So,
absolutely.
If so, yeah.
And just to reemphasize again, right, there are so many players, right, all watching these movements and all using these computer programs, right? And some people will say, well, that makes the markets very, very efficient, right? I would say maybe, or it makes the markets very, very volatile, right? And so some of the volatility that we're seeing and we are seeing is because of the nature of these constructs that actually now exist in the markets.
Yeah, absolutely. And keep in mind that when a broker tells you, this is a great thing to do, you should really do this, they're making money every single time.
Yeah.
They're the ones that don't lose.
Yep.
Yeah, remember, there's 2 winners in every trade and 1 loser. So,
that's why a lot of the brokers and a lot of the investment bankers are talking about, well, you should buy this now or buy that. Right? They want you to buy anything, right? Because every time you buy something, they make money.
Yeah, absolutely. And a lot of them, they've got economists who sit there, and you wonder why. Why do these companies have like 4 economists? And it's because they've got a bullish one and a bearish one, and one who thinks about it in this manner, and another one who thinks about it in a different manner. And it's, which client are we seeing? Do we think we can get a buyout out of them? Oh, great. We'll add our bullish one. Do you think this guy's negative? Okay, bring my bearish one. I want to convince him to sell. And so, it's a they haven't always got your best interest in heart.
Funny that. Now, there was this quick question that came in a little while ago. Could Ukraine default? I think they have a lot of US dollar debt. I mean, that's a valid question, I think, at the moment, isn't it? Insofar that with all this disruption there is debt that Ukraine has. And so you've got to ask the question about it.
Yeah, absolutely. Look, Ukraine could absolutely default. I think I'm more concerned about Russia than the Ukraine insofar as I think, well, certainly at this stage, where as things are sitting, I think there's plenty of countries that would be happy to extend terms to the Ukraine, or if there's debt that's due, that we can roll that over, and let's wait till you're not getting bombed and all that sort of thing. I think Russia's the bigger issue about what happens with there, and there could be quite possibly will be is probably strategic defaults about, okay, well, you're a US investor where we owe you this interest, we're not paying you. We can't, sorry, you shut us out of the SWIFT system.
Yeah, that's right.
We'd love to pay you, but we're
not our problem.
Yeah, that's right. Tell your government to switch SWIFT back on and we can pay you.
Yeah.
So,
And there was a very interesting article over the weekend that somebody wrote saying, well, it was the last weekend a Lehman 2.0. In other words, you went to bed on Friday night assuming the market to be one way. on Friday morning, suddenly all this SWIFT thing had happened, and suddenly Russia was on the nose, etc., etc. And that means that there was a liquidity question and a default question that wasn't there the previous sort of Friday afternoon.
Yeah. As I was saying before, I mean, my guess, and I don't know these things, but my guess is that they've been to the big, banks they're worried about, things like your Deutsche Banks and INGs and things like that, and tried to work out, okay, if we do this, what's going to happen. So they could certainly get it wrong. We could see things happening there. But I think the central banks are standing next to the governments, the European Central Bank and the US Central Bank, I think will be standing by, ready to help out financial institutions that might have timing issues or sanction type issues.
Absolutely. Well,
so there's a chance of mistake. But yeah.
My conclusion was the fire hose will be ready.
Yeah.
More liquidity is coming.
The bigger problem will be hedge funds.
Yes.
If we see any of those, because if you're, do you want to stand up and say, oh, look, there's this hedge fund that's, leveraged up to $100 billion worth of Russian debt, and they're charging 2 and 20 to their customers, and there's a bunch of some of the richest people in the world who own this and who have invested in it. And by the way, they've just might be bringing the financial system down. How about we give them some money? He's not going to be a popular. You're not going to be a popular politician if you're doing that.
Absolutely.
So that's a big risk, and we just don't know.
No,
I mean, what that is.
So we're coming to the last 50 minutes now. Earlier on, Cookie Boy asked a question about expectations on interest rates in Australia, and we touched on it briefly, but I just wanted to come back round again because the Reserve Bank basically gave nothing away today. They said, look, no, we'll wait and see. Right, we'll be data dependent, but blah, blah, blah. The markets are saying, no, rates are going to rise, and we showed that the yield charts earlier on. What's your sense? Is it important? Is it going to happen? Mortgage rates, fixed rates are going up. Variable rates are going down at the moment. The data that came out today from the new mortgages were very high, particularly on the investment side, which suggests to me that the investment part of the market's pretty hot, which suggests to me also that APRA and RBA might be starting to get twitchy with regard to that momentum. So the case for maybe raising interest rates, but they know that if rates are raised, a lot of people are going to be in deep doo-doo.
Yeah, I mean, we've already had a rate rise as well. Just to remember that our fixed rates have gone up as fixed rates roll off now, and so most of them were sort of on that 3-year time period. As they start to roll off, they're all getting a rate rise, and new investors can no longer invest at sub 2% interest rates. So we've already had one, I guess, is the first thing I'd say. I think if they go too quickly, it will be a mistake. I don't think the Australian economy can handle it. I don't think they will go quickly, but I don't. They have a credibility problem with me as well as the rest of the market. Look, I don't. They say they're going to do stuff.
Yeah.
They didn't last time.
No.
Will they follow through this time? I don't know. And so there's certainly I think, in my opinion, Australia's got less of a reason to raise rates than most other countries. The inflation's a lot more contained. Our wage growth in particular is a lot more contained. We're throwing the borders back open to immigrants and trying to bring them in, which should keep inflation down. Wage growth down. Could I see a scenario where the rest of the world's all raising rates and the RBA feels like, well, if everyone else is doing it, then maybe we should do it. I could see that. I could see that happening. So, So I guess what I'm saying is, I don't think they should raise rates too quickly. I've got more faith in that assessment than I do about whether they will or won't raise rates. So I'm really not quite sure.
My theory is they'll react to what happens around the world. So if the Fed starts putting rates up, Bank of England has already done it. New Zealand's already done it. I suspect that they will, but they won't initiate it unless that happens.
No, I think that sounds reasonable to me. Be more hopeful we'd run it off our own settings, but
don't change the habits of a lifetime.
Yeah, that's right.
Yeah, very interesting. So, as we sort of come towards the end of the show, there's two last topics. The first is just in terms of your current portfolio positioning, because you said you'd position quite early for some of the downturn that we've now got. So, what are the leading indicators that you'd be looking for to change that again? And then, secondly, we might just touch briefly on the performance of the portfolio, because actually you've done quite well.
Last year was a good one for us. So. So in terms of our current positioning, so let me split it into two parts. About one is in terms of the overall asset allocation. What are we doing in terms of cash, bonds, shares, international versus Australia? And then the other part is within the shares, what types of shares are we looking to buy? So or are we owning? So we're still sitting on lots and lots of cash. We've sort of got 30% plus, I think, sort of ready to go, ready to put back into the market. If we saw a reasonable fall, and we saw that, in particular, we start seeing central bank and the US central bank being more accommodative and less hawkish, then we're piling in. There's a whole bunch of things that could go wrong with that. And financial crises and problems with financial plumbing and all those. But I think one of the key measures we've been following is emerging market debt, and looking at some of the high yield debt, and those rates keep going up. That the Fed was pretty firmly behind them, and it's pretty hard to say, well, we're raising rates, but we're going to try and keep these corporate spreads in. So that's sort of the one of the danger signs I'm watching for. I'd want to see that's sort of at a level where I'm comfortable with before we start getting back in. And part of the reason for getting back in is the expectation that that the Fed will turn around and be a lot more accommodative with monetary. So if we're worried about that, then we'll stay longer on the sideline. And if we're convinced of it, we might move earlier. So that's the sort of overall. Within Australia versus international, very much international still. The real benefit from international is, as we saw last week, when we see crashes in markets, typically we also see the Aussie dollar fall away at the same time. And so, that provides a bit of a hedge on that. The markets might fall 3% and the Aussie dollar falls 1 or 2, and that sort of cuts your loss in half. So that's on that. Within the stocks that we're looking for, typically when you're seeing rising rates, what you'd be investing in value stocks. And so they're your banks, your energy stocks, your industrial stocks, basically a lot of things that don't have much pricing power. That's not what we think that's absolutely the wrong strategy at the moment. One is, energy prices are already pretty high, or very high. But secondly, stocks that don't have pricing power, typically you're raising rates because your demand's too strong. People are borrowing too much money and getting out and spending it and pushing inflation up. Well, the way we see it is demand isn't that strong. It's more about the supply side not catching up. And so in that type of environment, that's not the type of environment where the companies without pricing power are going to shine. That's where they're the ones that get stuck with, they get the inflation rises, but when the supply chains come back on and they flip back around, there's lots of competition in those sectors, and they can't hang on to those price rises. You want companies that are in sectors where they're putting up prices. So I think we saw Netflix and a few others, so a few of the streaming ones putting up prices. Those types of ones where it's like, well, in Netflix, if you've got supply chain problems with Netflix, it's your internet charges haven't changed. It's companies where they're putting through price rises because everyone's getting price rises elsewhere, and they figure they can put it on. And if prices come back down, they don't feel like they're going to have to give it back. They've got enough pricing power, they can hold on to it. So it's really the quality, we call them the quality defensives that we're sort of looking for. And the other thing is right now, I've got a long shopping list of stocks that I want to buy, and high quality stocks that I want to buy, and I'm waiting to see if they get smacked down low enough. I've sort of got to set the prices or the levels where I want to buy them. We're looking today at a bunch of lab companies that do sort of, whether it's selling equipment to testing labs or running testing labs and those types of ones. There's some very interesting ones. The whole idea is people will have more tests over time, and governments will spend more on getting these tests, and doctors will keep prescribing these tests. And so, quite like the sector, it's just been horrendously expensive with the whole COVID push, and it's fallen back a fair bit. Almost tempted. It's usually an expensive sector anyway, usually paying top dollar for it. It's now less expensive than it usually is. There's those types of ones where it's saying, if we see some more push down in that, they're the types of stocks I'll be jumping in, or some of those high quality tech stocks we're talking about in terms of saying, ones where you are genuinely getting the growth and you're not paying nosebleed prices for, jump in and start picking those up as you see prices fall back.
That's right. And it's interesting because you make the point that, timing is good and important, right? And sometimes not buying and waiting makes sense.
Yeah, that's right. And the other thing is, when you see crises happen, people sell the liquid stuff first. So when you get so you get this market downturn, and all of a sudden there's people going, I've just got to get out of big companies, big investment managers go, I've got to get out of this. I'm going from 50% equities to 40% equities or 30% equities or whatever. Dump all this stuff. They'll have a bunch of stocks in there that are just smaller, illiquid, and when the markets are falling, they just can't trade them. So instead of selling those ones, they sell all the big names that they can sell. And they're the days where you get, you often get at the start of the falls, you get some of the higher quality stocks drop away. And if you can jump in and grab those at that prices, and then the worst quality stocks are 2 or 3 days later are the ones that sort of start tipping out of bed. And so, it is a matter about saying, once you've got your cash there and you do want to do your trades, is then having it ready to go. The big thing I'd say to everyone, don't try and work out your emergency plan when the plane's on fire. Work it out beforehand. Where's my closest exit? What am I going to do? How do I open the door? All that type of stuff. So same with these is like, okay, what's my exit plan, and what are the stocks I want to buy, and let me have that ready to go. Don't be sitting there on the day when the market falls, thinking about valuations and I wonder how much I should pay for that stock. Is that low enough? And, have that thought process, done beforehand.
And the point there, of course, is that some dog stocks are always dog stocks, right? So, and many investors will hold on to them in the hope that maybe one day they'll turn into wonderful unicorns. Chances of that is quite low.
Yeah, absolutely. And, there's the Warren Buffett, when the tide goes out, you get to see who's swimming naked. My tip for that one for everyone is have a good look at your portfolio and pretend that you went to 100% cash. So pretend you had 100% cash. Would you buy that same portfolio back tomorrow?
That's a great test.
Because if the answer's, and because I see that with so many people with stocks where they're like, oh, I bought it at this price, and it's now, it was 10% of my portfolio, and now it's halved, and now it's 5% of my portfolio, but still 5% for this one stock, and I'm hoping it'll get back, and then I'll sell it. It's like, well, if you were putting portfolio together today, would you have 5% in that? Like, no, I wouldn't own it. Like, well, what are you still owning it for then? Get out of it. Get onto something else.
Very good advice.
Always the hardest thing to do is selling stocks that are down, but take that.
Take the hit and move on, right?
Pretend you've got cash.
No, that's a great advice. Last question for tonight. This is from Ray. Would you be looking to change your portfolio knowing that election may make decisions risky? So, there's an election within 3 months. Is that factored in, or is it just, are you agnostic to the result?
Relatively agnostic to the result. Typically, there is very little between the parties, and Labor's running a very, very small target. They're basically Liberal Party policy minus a couple of percent here and plus a couple of percent over there. Like, it's really there's genuinely not a lot of difference. Sometimes you do get big change within. It is worth watching those ones where you get Trump elections where promising to cut corporate taxes from 35% back to 17% and 15% I think was his original promise, and they're ones where you can look and you can say I can see the valuation upside from all these earnings coming through. the election we're having at the moment is, while there's I don't know, let me put it mildly, that I do think there's a relatively stark choice in terms of the personalities you're getting on both sides. I think, in terms of announced policies, there's really nothing to move the needle from either side.
And it's interesting because I noticed that in Victoria, the government's there just removed one of their policies, which was to effectively charge 1.5% to developers, right? Because it became politically unacceptable because of the pressure from the development community, which is another example of how the two sides steer a very narrow path and are very, very close to each other on so many policies. It's almost hard to see the light between them. Yeah,
they're all getting donations from the same donors. I mean, you see that in the donor list, $1 million to that and $900,000 to that party, and so yeah.
Doesn't make any difference. Damien, we're out of time again. I mean, these sessions go so quick, but I want to say thank you very much for sharing your thoughts this evening, and particularly at this time. Yeah. And enjoyed getting some questions from the audience, and also exploring some of the specific issues. And congratulations on the performance of the portfolio. If people want more information about your particular approach and the Walk the World Fund, which is driven by Nucleus Wealth, you can go to walktheworld.com.au and get the information there, or you can go to Nucleus Wealth and get the information there. There's a lot of transparently available information which helps people understand what you do, how you do it, and you're most transparent of probably all the managers that I look at. So keep up the good work.
Yeah, thanks for that. And actually, it's worth. I mean, it's only a half a sell, so you can still keep listening. Is one more piece of advice. We've got a lot of people who have been around 20, 30 years in the markets, but in the last sort of 5 years running our own fund, and they've got a lot of people who come back and keep saying, "Oh, I'm waiting for the next downturn, then they're going to give you some money," and then the next downturn comes, and they're concerned, and and the issues, and they haven't got an account set up, and then they start setting up an account, and then by the time
it's too late,
and it just never happens. Yeah. And then they say, "Oh, I missed that one. I'll come back and next time it happens." And so I guess what I'd say to you is, regardless of whether you're doing it with me or you're doing it with somebody else, pick whoever it is, but set your account up, get everything ready to go. You don't have to invest today, but at least know that if you're if you can do your own investing and you're sitting on the sidelines waiting, don't go, today's the day I'm out buying, I'm going to go and set up an account. Oh, actually, I need to do this, and I need to, I need my wife's details, or, it's a trust account, or, things happen. So, get in early, set things up now, work out your emergency plans and what you're going to buy, and then you can enact them.
It's great advice, actually. Be ready to pounce, because there will be opportunities if you've prepared and ready. But what you can't do is to think, actually, and then you realise you have to fill out the forms and go and get to the bank, and 5 days later the markets have recovered and you missed the opportunity, right?
Yeah, that's right. T+2 to transfer here and there.
Yep. Yeah, no, I've been there to see that, and it is very important that people actually think ahead. So thank you very much for your time once again. We'll do it all again in a month's time, and goodness knows what the markets and international situation will be, but I'm sure it'll be worth exploring some more. So
let's hope it's less exciting than this month. Yes.
Yeah, I hope so. But thank you very much, and I'm going to take you off air now, and then I'll close the show. See you later. Cheers.
See ya.
Well, there you are, folks. Just before I go, just to show you that the doggy cam is now working again with 2 dogs rather than 1. So Meteor came back, and they've been sound asleep the whole time. So they've been taking the odd note on investments as they go forward, which is quite fun. And just to say that next time I want to explore the crypto world with Adam Stokes. So he and I are going to discuss what's going on there, and I'm going to try and pull apart some of these questions about to what extent is crypto different from gold, and with all of the ETFs and things that are developing, how does that play out? So it'll be interesting to get his perspective. So make a note of that for next week. And I want to say thank you very much for spending some time with us tonight. Really enjoyed speaking with Damien and getting the questions on the show as well. And take care, keep safe, keep dry, and we'll see you next week. This is Martin North from Digital Finance Analytics, signing off. Cheerio.